Hey y'all, welcome to my channel. My name is Alexia and I am the owner of Elite Services, which is a remote tax and accounting firm which helps individuals and small business owners understand and organize their financial data so that they are able to make informed and strategic financial decisions. In today's video, I am going to give you 5 tips when it comes to increasing your tax refund. Tax season has swung around again. We're in 2025, and so it is time to file those 2024 taxes. And if you, like millions of others, would like to see a refund, especially in the thousands, then stay tuned because I'm going to give you 5 tips in order to increase your tax refund and offset any taxes that you may owe. Let's get into it. All right, so my first tip is to maximize your filing status. Choosing the right filing status is very important. It's the first step when it comes to filing your tax return. You want to look at your previous tax situation and look at, the following changes, such as did you get married? Did you have a child? Do you have children? Did you have a spouse who passed away? If any of these apply to you, then you want to correlate that to the correct filing status. If you are married, you have the option of choosing to file separately or jointly. Married filing jointly is the most advantageous filing status when it comes to a tax return. When you file married filing jointly, you have access to more tax benefits. So, for example, you have a higher standard deduction than if you were to file separately. And also, your threshold for a lot of credits or deductions is higher when you file married filing jointly. Also, if you have any qualifying dependents, such as a child or a qualifying relative, then you can file for head of household. Head of household also has a high standard deduction, so it can offset the taxes that you owe, lowering your taxable income. And then qualifying surviving spouse applies to those who were married and they had a spouse that passed away in the previous 2 years. So if you had a spouse who passed away in 2024, then you would not be able to file as a qualifying surviving spouse. You would have to file as married filing separately or married filing jointly. It's up to you. If you had a spouse who passed away prior to 2024, then you qualify to file as a qualifying surviving spouse. And that allows you to have access to a higher deduction as well, similar to married filing jointly. My second tip number 2, is to see if you have any qualifying dependents. We often think that qualifying dependents only applies to children, but that's not true. Qualifying dependents can be either a child or a relative who has lived with you for more than 6 months out of the year. But there are exceptions. For example, if you took care of a parent, such as a mom or a dad, and you provided more than half of their support, and they make less than the income threshold, which is $5,050. If they made less than $5,050, you provided more than half of their support. They do not have to live with you because they are the exception to the residence rule because they are your parents. And so they can qualify as your dependent as long as they, your mom or your dad is not married and they don't plan to file a joint tax return. And if they do decide to file a tax return, it must only be to claim a refund on any taxes that they overpaid. And so the qualifying dependents can be, again, your parents. It can be grandparents, aunts, uncles, a child, a foster child, an adopted child. It can be a brother, stepsister, half brother, half sister. It can be a niece, a nephew, a grandchild. It can be a cousin, even a friend. You can claim a friend as a dependent as long as they meet all of the qualifying relative rules. So look at your situation, and if you provided more than half of someone's support, then see if you can qualify them as a dependent. All right, so tip number 3 is to see if you qualify for any above the line deductions. There are above the line deductions, and the line just means that these deductions are taken before your adjusted gross income is determined. So see if you qualify for any above the line deductions, which some include if you pay student loan interest, if you contributed to an IRA or 401k, if you had educator expenses, if you're a teacher and you came out of pocket for any supplies for your classroom, and if you have any moving expenses if you are in the military. So these are above the line deductions, and you can see if you qualify for any of these to help lower your taxable income. All right, we're on tip number 4. Tip number 4 is to maximize your credits and deductions. You want to make sure that you are taking full advantage of any credits or deductions that you qualify for. Deductions are any expenses that you pay for, and they help to lower your taxable income. Deductions affect your adjusted gross income before you take the standard deduction. Once you take the standard or itemized deduction, then you come up with your taxable income figure, and the lower that is, the lower that you pay in taxes. Credits can either be refundable or non-refundable. Refundable credits are those credits that get refunded back to you. So if you end up owing 0 in taxes, those refundable credits, any amount left over, will be refunded back to you. And so credits, therefore, they lower your tax liability. And if it's a refundable credit, they put money back in your pocket. And so you want to use a combination of both credits and deductions to maximize your tax refund. All right, and my final tip is, if you are a business owner, you want to make sure that you are claiming as many expenses as you can. Now, these expenses have to be necessary and ordinary for your business, but you want to make sure that you're going through all of your financial records and you are putting as many expenses as you can on your tax return in order to lower your taxable income and therefore lower your tax bill. So if you have any startup costs, you can claim that even if you didn't make a lot of money. If you use your vehicle for work, you can claim that as an expense, and you could take what's called the standard mileage deduction, which calculates it for you. You can also take a home office deduction if you work from home and conducted your business from home. And if you work from home and you had to use the internet, you had a phone, a fax machine, any of that, you can claim those deductions as well. So comb through all of your records, all your receipts, pull those figures up and claim as many expenses as you can. Now, once you lower your taxable income, you want to make sure that it won't affect anything else. So taking a lot of deductions lowers your adjusted gross income. And if you need that to qualify for anything else, it can have an effect on that, such as, you qualifying for a house or a loan. So you want to make sure that you're considering all of the other things that you need to do with your tax return, and then make the best decision for you from there. You also want to look at if you engaged in any gambling, if you had wins or losses, if you traded in the stock market, and you had more losses than you had wins, you can claim those on your tax return, and it'll lower your tax liability as well. You also want to look at any income that is actually excludable. You don't have to put it on your tax return, such as alimony if you were divorced after 2018, child support, and any other government assistance. Those streams of income, those types of income are excludable from your tax return. So if you are receiving Social Security and you're not receiving any other type of income, you may not have to file a tax return. Also, if you received any gifts or inheritances, those are not taxable income. And finally, you want to look at if you had any capital gains for the year. And you want to see if those capital gains qualify to be long-term capital gains. If so, you could qualify for the capital gains tax, which ranges from 0%, 15%, and 20%, which is significantly lower than the ordinary tax rate. So if you had any long-term investments, long-term meaning more than 1 year, then you could qualify for capital gains tax rate. All right, y'all, that's all for this video. Thank you so much for watching. Make sure that you like this video if you watched to the end, and subscribe to the channel, as I will be posting more videos around finances, taxes, accounting, and ways in which you can achieve financial freedom. All right, I'll see y'all in the next video, which is this one.